Well, the US market rallied on the back of economic growth prospects in 2014. In 2015, the global market faces OPEC oil floods, an anxious Europe and a fairly stagnant Japan. So what does that all mean for the local market? Well, with record low interest rates, reduced petrol prices, solid home building and an improving job market, CommSec is suggesting the ASX 200 will nudge 6,000 by the year's end. UBS also sees growth with a target of 5,700. So with overall market growth expected, where exactly should investors be putting their money? Well, here's a bunch of different stocks analysts are tipping for the year ahead. And starting with the heavyweights, with Alumina's enterprise value less than half the replacement cost of alumina capacity, value is compelling. Morningstar says accumulate this stock. Woodside Petroleum is now almost debt-free and has the ability to pick off the best assets or companies from a field that will be weakened by current oil and equity market conditions. It's a buy for Hartleys and Stock Analysis and an accumulate for Morningstar and Patterson's. And of course BHP Billiton, which is highly diversified and has lifted iron ore production by half in the past 3 years, though pricing is fluid. It's rated a buy by Morningstar for its dividends alone. But if it is pure dividend divas you're after, take a look at these stocks. Medibank Private, which Hartleys expects to attract more buyers as managed funds seek to balance their portfolios. Argonaut Securities suggests the absence of any debt will produce solid long-term earnings growth as the federal government comes to rely more on the sector to partially fund escalating healthcare costs. With a revamped access agreement to the NBN now under its belt, Telstra has risen in a fairly bleak market and may well have more to come in the eyes of many. A National Australia Bank could deliver earnings per share growth of more than 27% compared to last year. Hartley says a fully franked dividend yield of more than 6% is nice too. If you're looking to catch a rising star, then look no further than Calzada. With its acquisition of Polynovo, it acquired the burns treatment Novasorb, a biodegradable polymer or plastic sheeting. Colourpack Designs makes cardboard cartons for all sorts of industries, from cosmetics and pharmaceuticals to food, beverages and wine. And listed vet play Green Cross Vets is a rapidly expanding chain of vet practices, now boasting a broader pet care business with a $330 million purchase of Pet Barn. All up, it has more than 120 stores and 100 vet clinics across Australia and New Zealand. Analysts say it's still worth a buy. If you're willing to take a bit more of a punt, then try these possible performers. Capilano Honey, which has doubled in price in the past year but still has potential, rated a buy by Criterion. eMerchants is a non-banker issuer and processor of prepaid plastic cards. Its well-regarded ability to combat fraud is liked by the corporate world, but curiously of little interest to banks. Expanding into Britain, it appears on the cusp of profitability. And also Skill Group, which provides staff to healthcare, manufacturing and resource industries, has been heavily marked down on the busting of the mineral boom. But since only a quarter of Skill Group's revenue comes from mining, it could be worth a look in these tougher times, according to Morningstar. If it's risk you're after, then try these bold calls, because who knows what will happen tomorrow. The stable and favourable long-term outlook for the childcare and healthcare industries will underpin Arena REIT's long-term cash flow and also sustain its distributions to shareholders. It's liked by Lincoln Indicators. Berkeley Resources is a growing high-grade uranium resource. It's got an outstanding management team, strong cash at the bank and is liked by Argonaut Securities. And Retailing's Third Force Metcash has slipped recently on failing to reach market expectations, but a new chief executive could achieve a turnaround. It's a spec buy from Criterion. If you're determined to play in the resources sector, then try Diversified Miner Independence Group. It's got a strong balance sheet with positive cash flows at current prices across all commodities mined. Outside of the majors, it's one of the better defensive miners due to its diversified and quality assets. It's liked by PCF Securities, Stock Analysis and Argonaut Securities. Northern Star Resources is the rising star of pure gold companies with moderate operating costs and excellent exploration appeal around its existing 4 mining camps. Meantime, Dore Minerals is liked by Argonaut and PCF Securities. Oil and gas prices have plunged, but have they hit bottom? If you're looking at this sector with optimism, why not try Carnarvon Petroleum, which stock analysis says is worth a punt, Otto Energy, which now trades at a discount to its expected cash backing, and AWE, which should survive a year or two of low oil prices, according to stock analysis. Morningstar rates it a buy, as does Argonauts. On the online space, analysts are looking at iProperty, which operates market-leading online property portals in Southeast Asia. It appears well placed to snare property advertising that elsewhere in the world is stampeding away from newspapers towards online. This stock is rated a buy by Morningstar. Also, Shoply is a rare pure-play online shopping exposure which has grown since its debut in 2013. It's moved from an internet advertising house to acquire several related businesses. Criterion rates Shoply a speculative buy. Skyfi is also of interest in this space. In the tech sector, the experts are eyeing Carnegie Wave, whose shares have been firming in the wake of the commissioning of the Wave Power Group unit off Garden Island near Perth. NextDC, which runs big data centres that host companies' computer servers in the cloud, the company has enjoyed strong revenue growth and is poised for profitability. And also Premium, a software company that offers investment administration and financial planning technology platforms for the financial services industry. If gaming, though, is more your style, then take a punt on Ainsworth Games Technology. The company is led by a pioneer of the industry and executive chairman Len Ainsworth, one of the top 3 players in the mature domestic market. It's chasing opportunities offshore where earnings are surging and more licences are being secured. Rated a buy by Morningstar. On the consumer front, lower petrol prices leaves more to spend, so try companies which are likely to benefit from this, like carsales.com and Wesfarmers. A strong performance by Coles and Bunnings in the first half of the financial year has been slightly offset by an underperformance in coal, Target and liquor. Hartley says, though, the key will be early in the new year when the important Christmas season results are released by Wesfarmers. Also, the healthcare sector is expected to keep well in 2015, according to analysts. CSL has a strong product pipeline. The announcement of an extension of a further $950 million on-market buyback will also be supportive. This stock is liked by Lincoln Indicators. And finally, Ramsay Health Care offers continued growth following its contract win to build and operate healthcare centres in France. The company also announcing a foray into China to become the first big international hospital operator to establish in the tiger economy. So whatever you favour for long-term growth or fast return risk, be sure to consult your financial advisor or licensed stockbroker for advice. Happy trading.